What's going on, everyone? My name is Nicholas Merton here at DataDash, and today is May 24th of 2021. Well, folks, I hope you're having an okay or better day wherever you are than the last couple days, as it's been nothing but chaos in the cryptocurrency market. However, over the last 24 hours, there have been some signs of hope. Markets are green, a wash of green across the board after the bloody sell-off we had over the last couple of days. And the question here remains is whether or not we're still going to be stepping in towards a full-on bear market. Have we seen the top of the market? And outside of that as well, maybe more positively, could this just be a mid-cycle correction that we've seen time and time again within previous crypto bull markets? So we're going to be diving into that, as well as doing a sponsored review of Peanut, which is a DeFi project that offers a wide range of services to liquidity providers on automated market makers like Uniswap. So we're going to be diving into one of the cool new tools that they built later on. But let's go ahead and dive straight into it, guys. Taking a look across the board in the market, finally, for the first time in the last couple of days, we finally see some green price action. Bitcoin up nearly 16%, Ethereum up over nearly 31%, Binance Coin 41%. But across the board, guys, it's not just these plays. Across the board, we are seeing massive double-digit green price action in the vast majority of top 100 coins. Again, as you just scroll down the list here, guys, you can see the overall market is feeling the benefits. And the only things down here at the bottom are stablecoins. So this is a good sign here to see that the market is actually starting to bounce up quite significantly. And I think it's very clear by now, though again, I have no doubt some people believe it's a bear market, et cetera, right? Well, we'll talk about that in a little bit. That at least in the interim, this is the bottom here. We've seen kind of the capitulation point, the liquidations go through for margin traders, and now it's finally time where people are buying up cheap on spot and in bulk. As you can see here, people are clearing through the order book as there aren't many limit orders that are preventing price from rising higher. I want to go ahead and start, though, the conversation with a tweet that I put out the other day. And we talked about this. I've talked about it since I did my video on the beach where it looked like my house had collapsed. But the major thing I want to talk about, guys, is the only big action item that I took. I think what speaks louder than my words will be my actions, right? And that's the fact that I bought the dip on Ethereum at 2190. A 50% clean cut correction from the highs. Didn't pick the absolute bottom, went down to 1790, I think, for the absolute low. So a couple more $100 down. But it's not really about picking the absolute bottom. It's a matter of buying in at a discount range where you know the risk to reward profile is much more favorable. And, I have to say something, guys, which is that, I think it really does have to do with practice and mindset within markets. Taking a look here just at Bitcoin's chart, right? There are really two ways you can approach market, and that is where you decide to take risk. Do you decide to take risk when everyone is excessively confident in an asset where it seems like things are just going well and they can't go any better? It's phenomenal. The market's doing great. And you see other people taking risk, taking on excessive leverage, borrowing credit in this case to buy more crypto and expose themselves more and more to the market so they increase their already luxurious gains. Or are you going to make the difficult choice, the one that very few people do, but it tends to be large money in this case that does this, smart money as it's commonly referred to as? And are you going to buy at a discount when everyone else has said the gig is up, the game's over, I'm down on my money, I didn't sell, and I might as well sell now before it goes to zero? I'm not going to sit here and try to ask you guys what position you found yourself in during this pullback. I understand that's a very personal thing for all of us. I've been on both ends of the spectrum. But I got to tell you guys what I did this time around, and I think it's a learning experience, one that still we're in a range of price where you still have an ability to recoup in this case and not like completely step out of the market, which is to do something that I did, right? And I basically not only bought the dip, I decided that this is a period of time where I felt comfortable taking out credit or taking out a loan to increase my exposure to crypto, right? Now, again, I've already talked a little bit about this, the loan that I took out. I'm not here to encourage you guys to do that, but what I want to speak about here is the difference in time from where I took extra risk from my already decent exposure to crypto than where other people decide to take risk, or where the crowd or the herd is going to take most of their exposure to risk. It certainly isn't down here when no one's talking about it. And it certainly isn't here at corrections. It's a periods of time where prices are absorbently high. They're at all-time highs. It seems like the market just can't stop going any further, right? So that's a very important lesson here, guys, is to not capitulate when you have these couple of days where price is starting to solidify a base and we start to see some optimistic price action. And not just in Bitcoin, but in a variety of places across the board. Ethereum, for example, bouncing all the way up, recouping a couple days of lost price action back to somewhere around the midpoint on May 22nd, right? Up nearly 22% today. Massive rebound, not to mention as well at a consistent support range that we held many times here and over here, and what was serving as previous resistance, right? What we saw here, generally speaking, was a domino effect of liquidations from people who had excessive leverage in their positions on Ethereum. And those liquidations caused capitulation down to previous support where smart money bought in on the dip. And this is very common with cycles, guys. You can see here, for example, we had kind of the first initial wave here, then price kind of consolidated. We had a clear point of resistance. Price got above there, made it support twice, and then had the secondary wave of the existing cycle that we've seen so far. Well, what's really nice here is that it tends to be that that second wave closes down, we lose those gains, we make support, again at that consistent support range or nearby, and then we eventually come back up. I'll go ahead and just kind of draw it here with the polyline tool so you guys can see what I mean. You basically start to come back up, right? And don't take this at face value, right? You basically come up here and then eventually break out above and you continue climbing higher on the chart, right? You start to set room for new all-time highs or new relative highs in the cycle, right? So this is what, again, if we are just experiencing a mid-cycle correction, this is how it should generally play out, right? Smart money comes in to buy when people are selling. They take a discount, just like you'd want to go buying discounts for goods or services. They do the same for assets, and they ride the wave higher, right? And they're selling at these points up here, or they're the sell orders that actually cause those domino effects of liquidations. They give them such nice, hefty discounts. Don't play into the game of leverage, guys. The only parties on average who benefit are smart money and people who know how to use leverage. And I can tell you guys, they're increasing risk down here versus up here. They're not doing it at $4,000 Ethereum after it's already climbed from $400 just back in November of 2020. So I'm not trying to be rash about it or harsh about it, guys. But what I want to drive is a point here, right? Let's take a look at the chart for Uni here, right? It's been one of our big DeFi plays. Again, guys, this is a great chart, I think, as an example for not getting caught 2 steps behind, right? Sure, I was holding my Uni position just like I am nowadays, previously at $43. Would have been great to sell it and take some profit, right? Oh, I didn't. I'm holding Uni generally for the broader cycle here. I want to hold it until we reach towards what I really confidently can say is the market peak, and that a lot of the benefits of layer 2 have finally started to materialize for Uniswap. We haven't gotten there yet, right? And it came down all the way. I watched my investment go from 40-something dollars down here to $13. Is it painful? Sure. But did I let my emotions get the best of me and sell my order at the bottom? No, I didn't. What I did is, again, as we went in this lower price range, I opened up loans off of it and increased my exposure to the crypto market, because my collateral at that point, or that asset, is much better as collateral than when it's up here at 40 bucks and has a much higher chance during a correction to get liquidated, right? And look at that. My Uni tokens are back to $23, right back to where they were on March 2nd of 2021. Sure, it's not 40-something bucks, right? It sucks, but at least I'm not 2 steps behind where I sold this to some other smarter investor who is now way up if they bought at that price range. So I hope you guys see my point there. Again, just another example here. And what's really interesting is if you look at the log chart or the standard chart, you can see here that from this kind of midpoint in the overall rally with the previous open high here in September of 2020, notice how it builds this beautiful kind of like midpoint line here where there was support, bounced up strongly, and now we've got that room to move higher and possibly revisit the all-time highs as well as turn into new all-time highs if this is just a mid-cycle correction. It's very likely that we're past that if this is just a mid-cycle correction, right? And last but not least here, I want to take a look at Litecoin. Now, Litecoin, to be completely honest with you guys, this has been one of the ones we built a position in quite heavily back here in March, so about neutral in the position here, right? you can see here Litecoin had a pretty horrendous pullback, to be completely blunt, right? Really severe pullback here on Litecoin. But what's interesting, if we take a look at the chart, right, is that generally speaking, we topped out the same range here. And when we came down to find support, it's on previous resistance back here from 2019, here from early January 2021, and also back here during December. There's many points of support. Now acting as support again, and smart money again during peak fear, peak capitulation in the market. They're coming in buying in. They're buying in on the low end of this wicks here. And you can see here that we've gone all the way from a low point, and I'll get the specific figure here, a low of $117.58 now up to $171. Didn't have to pick the bottom, but get it anywhere in between there, that's already a great profit. Not to mention, you've got a lot of room to make up for, right? When people realize that these sell-offs are caused by liquidations, people start to realize, wait a minute, now we've got a lot of upward room here that we can probably regain in a very short period of time. And this is a point that I want to talk about here, guys, because again, yeah, the chart looks, by far does not look good. Like it looks like it was a dramatic sell-off, right? But I want to point out something that I know a lot of people are debating about, and this will lead me to my kind of conversation of whether or not I think this was a short-term correction in the overall cycle, or if this was the beginning of a bear market. A lot of people would say, "Oh, Nick, like this is the bear market. You're biased in this case. You don't realize this is the end of it all, Nick." And it's like, okay, maybe I'm wrong in that case if I lean more towards the point of this being a mid-cycle correction. But let's say whether it's that or a mid-cycle correction that is going to be, prices are going to come back up, go back to all-time highs, and set up new all-time highs, right? No matter if it's either one of those cases, let's just take a look here at 2017, the last cycle here. What happened when we revisited this price range? Well, in a matter of 3 days, valuations leapfrogged back up from $148 to more than $280. So it doubled in a period of 3 days. Right? And let's say, for example, when we did down here, oh, it was so terrible, Litecoin went to $110 from its peak of $400, but it also leaped up to $250 afterwards. Again, another 100% move. So my point I want to drive here is that, like, look, if you think this is the end of the cycle, right, that's fine, but you don't want to, and I'm not arguing that you should just go out and trade these kind of up and down moves. What I'm saying here is don't find yourself selling at peak fear, guys, when you know that after 60, 70% corrections, buyers tend to come in. And even if they're just going to set a lower high, that lower high where you can sell is a lot better than selling at a peak point of capitulation, right? You see my point? That you can start to regain a lot of those, missed profits in that case, even if you believe that the cycle's over. So that's the point that I was driving. Why, why I made the decision that I did to, increase my exposure at the lows, buy where I did. It's paid off phenomenally well so far. It's paid off that I didn't capitulate on my positions during peak fear, right? Those two decisions have paid off quite well so far, right? And I'm still way up for 2021 as well as 2020 by far, right? And this leads me to kind of my final talking point here. I want to go ahead and, again, as I know I keep talking about margin trading and liquidations, but I want to show you guys something, just kind of prove my point here. This chart here showcases, and the green and red bars are short and long liquidations. The green ones are the long liquidations, meaning people who are borrowing capital that isn't theirs in order to buy crypto, in order to increase their profit potential on the way up, but also increase their risk profile. And vice versa, the red ones are for shorts. Let's focus on the long ones here. We're in a bull market. We can obviously see that there's much more long liquidations than there are shorts, right? Shorts don't last very long. It's much more spread out here as prices continue to climb. Whereas long liquidations, they really start to get hampered during these corrections. And they, as we've talked about before, they contribute to the corrections, right? Because you have a domino effect where people have margin calls and then liquidations where their underlying crypto they used as collateral in order to borrow margin gets sold, right? The platform, the exchange owns that. It's not theirs anymore. And they liquidate it to cover the depositor who lent out that money to you originally, right? It works a little bit different between, lending platforms like Celsius and BlockFi versus derivatives platforms, but the principle is generally the same. Notice that during these periods where we get spikes in liquidations, whether you're a short-term trader or long-term, even just over the last few months, tends to be where discount opportunities are, right? We got the biggest candle here in the last couple of weeks. Price starts to move higher afterwards. We see two major candles here, and on the second major candle, you start to see a return back up higher in prices. And then again, as we have a big spike here leading us towards the low range where we're actually at right now, right? So even if you bought on that day with massive capitulation in the market, or you bought a couple days after, right? This is generally where the market's bottoming when all these liquidations go through. This here is probably the most solid proof I can show you guys to prove two things: that the domino effect of liquidations from excessive margin trading is what's causing the mass discrepancies we're seeing in this correction versus, say, previous 2017 mid-cycle corrections. So they're more dramatic, the decline in percentage points, and even as the market's growing larger in dollar amounts, is going to be larger. And outside of that as well, this can be a great pinpoint to show you when, there was a lot of people who started leverage positions up at this price range who are now getting liquidated and being forced to sell their positions. Maybe that's the time to take risk. Maybe it's time to take risk when other people are regretting taking risk at much higher prices, where they were probably thinking they'd just get away with it, that the market would just go up. And that's exactly what I did in this case, guys. That was exactly my position, right? Now, I'm not saying, and I don't even want to sit here and endorse that you guys go take out any loans or anything. I recommend the vast majority of people don't even touch leverage or credit, because most people don't know how to use it. Plain and simple, guys. I'm only saying that. I'm not saying you wouldn't be able to do it. I'm just saying that I know for the vast majority, the thousands of you listening in, most people will lose. They don't know how to use it, and they sometimes let their emotions and greed get the best of them. But at the same time, it doesn't mean you can't, with your own money that isn't everything in the world, you can buy the dip if you feel that there's a good discount opportunity. And there's one last thing I want to talk about, guys, because I know there's a good chunk of people out there, at the end of the day, and good, decent-hearted people and stuff, just like all of you guys in the community. I like to think everyone has good intentions, even though they want to make money, right? I know there were a lot of people who sold in this period down here. Probably a good amount of you listening in. And I want to go ahead and answer the question that's probably on a lot of people's minds who did sell. And that is, Nick, I sold in that bottom range. Should I get back in the market? And this is a difficult question to answer, but there's usually two things I resort to when someone asks me this during capitulation periods. And if you guys see this in the comments, because someone didn't watch the whole video, you got to tell them to stay through the whole video and get them to come to this point. There's two key things you have to think about. So first off, if for that user in that case, I always at first ask them, what was going through your mind when you sold? What was the reason for it, right? Because people come from all different walks of life. Some people get in crypto and they have like $1,000, like, screw it, I'm putting in $1,000. We'll see what happens. It's like going to them, it's like going to a casino, right? And they do the same maybe in equity markets, etc. Because it's money they can lose, right? But if the money you have in crypto markets, whether from the initial amount you put in is really important, or the growth that you've seen in your portfolios is so important to where you now can pay for things that are so important, like your kids' college, buying your first home, covering your rent for that matter, like day-to-day expenses, medical bills, etc. If that's what's got you up at night when crypto markets are dropping, that is where you should put your focus, hands down first, right? That is key priority number one, to deal with debts, with life expenditures, etc., to make sure that you can live a comfortable life, right? I'm not giving you any financial advice. I'm not your financial planner. That's just general finance 101, right? And now the second point here that I would ask people is, if you're re-entering into the market, do you see future growth opportunity? Have you been convinced by what you've seen and stuff that this is just a mid-cycle correction? Do you think this is over, right? That's something that you have to answer yourself, guys, right? You have to look at the data. I can't tell you that. I can tell you guys personally, for me, I'm betting that this is just a mid-cycle correction. And what's nice is that whether I'm wrong or right, I'm at least in a position now where I'm quite confident it's going to rebound to some decent degree. And even if we set in a lower high, I'll be able to sell my portfolio at a much better price. That's my mindset. So you guys have to go out and determine for yourselves what you want to do. All right. Anyways, I've rambled on enough today, guys. Let's go ahead and we'll dive into the sponsored review of Peanut here. But I just want to say, if you guys need any kind of guidance during this time, again, just understand that markets are crazy, markets are volatile, and it's a part of the game. You got to be able to sweat and take on that volatility and go against your emotions during those dark times. Okay. So again, if you guys liked it, drop a like. Let's go ahead and dive in to taking a look at our sponsor for today, which is Peanut. Now, for those who don't know, Peanut offers a wide range of services to liquidity providers, or LPs, who provide liquidity to protocols like Uniswap, or automated market makers, fancy word for decentralized exchanges, that actually allow for them to be more efficient with the capital they provide. So whether you're a small participant in the market or a large participant, you can become a liquidity provider if you want. If you have an equal amount of crypto, for two major cryptos that fit into a trading pair like ETH USDC or UNI ETH, right? You can actually go out and be an LP and actually get rewards for it, which is really cool. But let's just go ahead and actually run a little bit about, what automated market makers are and how Uniswap works, and then we can dive into actually understanding how Peanut is fixing some of these issues. So Uniswap v2 was the version of Uniswap, or version 2, was the major version that people were utilizing for the last year or so. And it was a great protocol. It was much more efficient than version 1. And outside of that as well, there was a ton of people trading on it, basically being able to place market orders, trading from one token to another in an autonomous way through smart contracts, and to be able to do it where you get an agreed upon general market range rate. You know the slippage that you're going to face in this case, or the kind of the spread in this case, from what you're trading to. And it was great. It works phenomenally well. But there was a big problem that Hayden and a lot of the team at Uniswap had started to realize, which was that when you create liquidity pairs, in this case, an equitable amount of, say, Ethereum and USDC for people to trade, the problem with it is that as you add more and more liquidity, right, you don't get as much capital efficiency as you could, right? There's a lot of that liquidity that never gets touched because it's supplementing for potential price ranges as price goes up or down, right? And some of those prices may be way out of the kind of woodworks in the interim, right? So what Uniswap v3 offers is the capability here to have what's known as concentrated liquidity, where you can actually concentrate liquidity, even a smaller amount of liquidity in this case, into a certain price range to make it more capital efficient, to allow for greater slippage reduction in the sense of making trades. And this is actually an example here of the UNI token against Ethereum. We can actually click on the button here that says liquidity, and this will give us a general overview of the actual liquidity breakdown here for the UNI ETH pair. And you can see it almost kind of looks like a reverse order book in a sense, right? And basically what it means is that someone's providing liquidity between a specified range of price here, so that they can not only gain fees when the price is in that range, but also provide as much of their liquidity in that concentration and make it more efficient, right? And garner more fees for providing liquidity, right? So if you're providing it outside of the range, you don't garner any fees, you don't get anything, right? Or at least not as much, right? So this is a really cool thing about Uniswap v3, and it's a unique selling proposition about the Uniswap protocol because they're the only AMM that actually has this concentrated liquidity feature. But concentrated liquidity as a tool doesn't come without its downsides. As much as it's a great benefit for LPs who keep on top of things, it can also be a pain because if you have it concentrated for a very short price range, and let's say for the UNI ETH pair, UNI token goes really high and breaks out of that pair that we're supplementing liquidity for, we can get to a point where our liquidity is not earning any liquidity provision fees that the users are paying when they trade. So this is something that Peanut offers as a part of their product suite. And it's basically what they generally call automated concentrated liquidity. And whereas in this case, in manual concentrated liquidity, price is the green dot here, goes out of the range, you're not garnering any fees. They now have concentrated liquidity on autopilot, which mimics or follows the price and provides a banded range, a range within reason of that price. So you can actually generate fees in this case off of that band constantly, right? You're always moving that range you're going to provide liquidity and be able to generate LP fees for. as the price adjusts over time. So this illustration does a great job of explaining that. But you can see here that Uniswap v3 already makes capital efficiency much higher, potentially up to 5.24 times on average versus just putting liquidity in v2. And this is, again, why you're starting to see on the metrics here for v2, the volume starting to go down, in this case, as well as liquidity. It benefits both traders and liquidity providers. But outside this as well, with the use of Peanuts technology, you can actually potentially get that up to 7x capital efficiency. This really not only helps to make more money, but it also helps to manage the risks of fighting impermanent loss. And they kind of go hand in hand. Impermanent loss is a feature, or I would say it's a negative implication of being a liquidity provider in AMMs, where you can actually end up losing providing liquidity. So that's why there's the need for fees to help cover that impermanent loss. It's a bit of a deeper topic to talk about, but overall, guys, this is a really, really cool tool. And if you guys are interested, you guys can join the wait list here if you happen to be an LP in the crypto space. I highly recommend you guys take a look deeper into it. And outside of that as well, they've also got another cool tool here, which is on their website called the Fair Launch tool that they just recently launched. So if you're planning on listing a token soon, if you're working with a project that's planning to do maybe a fair launch on the market, or some kind of listing on Uniswap, you might as well consider using Peanuts' sniping bot system that they've built that helps to actually prepare for a fair launch. The problem right now is that there's a lot of people out there on the market. They're called sniping bots, or well, people use these things called sniping bots that basically look for newly listed projects, and it's all open and out there. They can literally see what happens right away on Uniswap. And what they do is they buy up a lot of the token supply. And the overall goal, what they do afterwards, as they've increased the price in this case, they're estimating that some people are going to come in and buy up as well as it's at a higher price, and then they sell the equitable amount in this case, leaving with some kind of margin from the original amount. Again, this is a bit of a deeper topic to dive into, but it's a problem in this case with AMMs and new token launches. What's really cool is Peanut has built a system where that in the same transaction you create that liquidity pool, you also are able to shield yourself or basically engage in the sniping activity yourself, so sniping bots aren't able to get to it first. And that's the only way you can do it is by having it in the same transaction because they're lightning quick. So it's basically where you'll be able to make sure you're the first who gets to buying these tokens before the sniping bots do, who are just trying to, again, arbitrage or make some quick money and then dump your token afterwards. You're able to beat them to it because it's in the same transaction as the actual liquidity provision, the creation of the pool. So hopefully that makes sense, but I think it's a very cool thing, and they offer this as a service as well that you guys can look into. But anyways, that's it for today's video, guys. If you thought this was interesting, please consider dropping a like. I think what Peanut's doing is very interesting in the sense of the kind of ranges of services that they're offering. But I highly recommend you guys look more into the automated or kind of autopilot system of concentrated liquidity that they're offering. I think tools like this make Uniswap's new functionality of concentrated liquidity truly efficient. I think that the benefits are understated here in this sense. But again, it'll be interesting to see how it comes out into deployment. That being said, everyone, that's it for today's video. Thank you for listening to me ramble as always, and I'll see you all in the next video. Take care, everyone.